Welcome to Dividend and Conquer, the channel where wealth building through dividend investing takes center stage. Today, we're diving into the universe of exchange-traded funds, or ETFs, and tackling one of the most thought-provoking questions in the investment community. If you could only choose one ETF to hold indefinitely, which one would it be? Imagine, you're in your early 20s, the horizon of opportunities stretches out before you, and amidst the wealth of options, you must pinpoint that single ETF that aligns with your investment vision. It's a challenging scenario, but not an impossible one. Now it's tempting to simply tell you the ETF that stands at the pinnacle of my list, but that would be like giving you a fish instead of teaching you to fish. I want to equip you with the reasoning and knowledge that guided me to my decision, so you can make an informed choice tailored to your unique investment journey. After all, investing is a personal affair, and what works for one may not suit another. Let's talk strategy, and begin by dissecting what makes an ETF worthy of being the one. I'm not talking about niche or sector-specific ETFs here, the kind that zeroes in on industries like healthcare, finance, or tech. Their scope is too narrow for our purpose. We're seeking something more encompassing, a fund that paints with broader strokes. Considering international ETFs, their allure is undeniable in the current geopolitical landscape, with factors like the debt ceiling threatening the economy's equilibrium. If the US were to falter, having investments in emerging markets or companies headquartered beyond American shores would be a strategic move. ETFs such as VXUS and SCHY present a compelling case, offering a robust dividend yield and a diverse portfolio outside the US. However, the potential total return for international ETFs tends to hover on the modest side, historically yielding around 3 to 4% on average. Their volatility remains fairly stable, which translates to consistent but lower returns. While international ETFs carry a higher risk due to their global exposure, broad market funds like these are deemed moderately risky. Moving to foundational ETFs like VTI, which tracks the entire US stock market, or VOO, representing the S&P 500, we find a vital component of any investor's arsenal. Their total return potential is balanced. They're unlikely to skyrocket or plummet. The volatility is relatively low, and the long-term data supports their stability, with the S&P 500 averaging a 10% annual return since 1957. That's a track record that speaks volumes about their reliability, positioning their risk level as low. Midway through this discourse, I'd like to pause and express gratitude for your engagement. If you're finding value in our discussion, please consider subscribing to Dividend and Conquer for more insights on making your investments work smarter for you. Now, let's address the segment that's garnered a lot of love, particularly in recent times. Dividend ETFs. SCHD, a personal favorite, exemplifies this category splendidly. With dividend ETFs, you're getting a 2-for-1 deal. Appreciating share value and a dividend payout that can either bolster your passive income or be reinvested to harness the power of compounding. SCHD showcases impressive total return potential, with an average annual appreciation surpassing 13%. It's a middle ground player in terms of volatility, and when we expand our dataset to a 20-year span, I'm confident it will shine even brighter. Risk-wise, dividend ETFs like SCHD are considered low, thanks to the stability provided by the value-oriented companies they hold. Finally, let's talk about the wild child of ETFs, growth funds. These ETFs are like a sprinter on an open track. The potential for high-speed returns is tremendous. Funds that fall into this category, such as QQQ, have witnessed staggering yearly appreciations, some close to 18% over the past decade. These ETFs house the pioneers of innovation, companies that shape our future. However, with great potential comes great volatility. A stellar year could be followed by a staggering loss, so we categorize their risk level as medium-high, higher than our other ETF contenders. So where does that leave us? If the ultimate goal is to choose one ETF to invest in for the long haul, I'd gravitate towards the category with the lowest overall risk. As much as I admire SCHD and VOO, the choice must be grounded in a track record of resilience and consistency. Today, my selection is VOO. It has stood the test of time and weathered many storms, but let's not discount SCHD. Given another decade to prove its mettle, it could very well take the lead. Now let's delve deeper into some strategies for picking the right ETFs and ensuring your investment choices align with your long-term financial aspirations. When considering an ETF for indefinite holding, several factors should influence your decision: historical performance, fee structure, dividend yield and growth, sector diversification, and the fund's adaptability to market changes. Historical performance is a reliable indicator of an ETF's resilience. While past performance doesn't guarantee future results, a fund that has navigated through economic downturns and market volatility is more likely to provide stable returns in the long run. Next, evaluate the fee structure. ETFs come with expense ratios, the annual fees you pay as a percentage of your investment. A lower expense ratio can significantly impact your investment's net growth, especially when you're playing the long game. The dividend yield and growth potential of an ETF are particularly pertinent for those focused on generating passive income. A fund with a consistent record of growing its dividends offers an attractive proposition for long-term investment. Sector diversification is crucial. An ETF that spreads its holdings across various sectors can safeguard against industry-specific downturns. This strategy can help mitigate risk and provide more consistent returns over time. And lastly, a fund's adaptability to market changes is essential. Look for ETFs managed by teams with a strong record of navigating market cycles and adjusting their strategies accordingly. This flexibility can be a significant advantage during times of uncertainty. As we've sifted through the characteristics of a desirable ETF, let's consider the investor's mindset. Patience is a virtue in the world of investing. The quest for quick gains often leads to unwarranted risks, but the discipline of holding a well-chosen ETF indefinitely can pay dividends, quite literally, in the wealth accumulation phase of your life. Let's not forget the power of dollar-cost averaging, DCA. This investment strategy involves regularly buying a fixed dollar amount of a particular investment, regardless of the share price. Over time, DCA can help reduce the impact of volatility on the overall purchase. The markets will fluctuate, but a steadfast approach to investing at regular intervals can smooth out the highs and lows. Moreover, it's worth noting the impact of economic cycles on your ETF choices. Understanding where we are in the economic cycle can help guide your ETF selection. For example, during a recession, defensive sector ETFs might be more resilient, whereas in a booming economy, cyclical sectors could see more growth. Remember, the choice of an ETF should align not just with the current market environment, but with your personal financial goals and risk tolerance. Are you saving for a home, planning for retirement, or building generational wealth? These objectives will steer your decision-making process. For the young investor in their early 20s, a broad market ETF like VOO could be a cornerstone of their portfolio, providing a foundation to build upon as they learn more about the market's nuances and their own investment style. In the end, the journey of an investor is as much about personal growth as it is about financial gain. Each choice, each investment brings new learning and experience. The key is to stay informed, stay disciplined, and stay the course. And with that, we conclude our deep dive into the ONE ETF scenario. Whether you're a novice investor or seasoned in the game of stocks, the principles we've discussed are timeless. Before we wrap up, remember that in the grand scheme, you aren't confined to a single ETF. The beauty of investing lies in the freedom to build a portfolio as diverse and dynamic as the market itself. But if you had to choose just one, which would it be? Share your thoughts in the comments below. I'm eager to see which ETF has captured your investment spirit. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. Thank you again for tuning in at Dividend and Conquer. If you've enjoyed this exploration into the world of ETFs and found it enlightening, please show your support with a like, and subscribe for more content crafted to help you on your financial journey. Until next time, keep investing, keep learning, and keep conquering your financial goals.